for those that were not here in the beginning, my name is Antonio. I'm the head of the research department at FX and FXCM. I've been working in the company like since 2000, I think, long time. I was born in Portugal, and I came here to US after I won a competition for trading. So I was one of hundreds of people that jumped into this Société Générale competition in France, and I won it. And why it was so great? Because not so much I liked trading at that time. I liked other things, like NGOs, like trying to save the world from hunger and all those things. But if you don't have money, maybe you should think twice. Once you have money, you try to save the world, but not yet. So I went there, I won. It was a round trip around the world. So instead of doing that, I took all my family, and we went to London to New Year's Eve. And once I went to London, I saw the financial center there, and I spoke with some people working in finance, and I fell in love with FX. And for a trading perspective, there is no better country than US. So I decided to come here, first to study, then to apply for a job. I went to FXCM. Here is my resume. Here is the trading strategy I have. My strength is really developing trading systems, not so much the research, saying that if the Fed does this, then the dollar does that. And here I am. I'm going to try to answer some questions in the end, but feel free to interrupt me, because sometimes if you wait, you forget about the question. The risk we take here is maybe take a little bit longer, but I'll try to make it short, okay? Before we go to that slide, I have a few questions, how many of you actually has a trading strategy? Not so much a system, but a trading strategy, a systematic approach to trading. How many of you? Yes. Yeah, partially. It's okay.
Could you explain what you mean between approach and strategy?
Approach and strategy, it's pretty much the same thing. People often confuse having a trading strategy with having a system. You do not need to have a computer or programming skills. Many of the best traders I met, they don't even have programming skills. They don't know how to use the computer. But they have a very systematic approach to risk, reward, and all those things. So you have a strategy. Does it make clear to you?
Well, then, a system is a mechanical piece?
Yes.
And a strategy is an idea of how you want to trade?
Yes, you can merge them together. What we see in FX is that people normally confuse, I have a strategy. So I have a robot, algorithm that does this, I press play, and it buys and sells. That's part of having a strategy. But the strategy is more global than that. You don't need to have a system, you don't need to have anything. You just need to be systematic in the way you do things. Every time you see something, you act in the same way. So there's a lot of discipline. How many of you bought actually a system? How many of you are interested in developing or using a system or using a strategy? And okay, good. One of the things that people always do is that they try to make the system in the very beginning the perfect one. They try to incorporate all market conditions, all types of currencies. It needs to work across the board. It needs to work during European hours, US hours, Asian hours. That's a big mistake. You need to make it very simple. And you also cannot just expect your system to perform very well from day one. But among all those things we notice in clients is that They buy normally a system off the shelf. They find a perfect system with a perfect equity curve, and they buy the strategy, or they use a strategy based on how it has been performing, or how the strategy developer actually coded and the equity curve looks so great. But that's a big mistake. Just think about it, and I wrote something there. It's a bit like clothes, right? Like the microphone will make some noise, but if you think about this jacket, for instance, I bought this jacket because I thought it would fit me, not because I thought it was the nicest jacket there. I don't have a body for a model, and I need to feel comfortable, most important than everything. So if I'm wearing this jacket for like a year or more, you need to feel comfortable and neat. If you are skinnier, or you're not so skinnier, and you buy something that doesn't fit, it's exactly like buying an off-the-shelf trading strategy. You buy it, you switch it on, or instead, you go to DailyFX, or you go to other site, and you find a strategy. And the equity curve is great. So you incorporate that strategy in your style. That's a big mistake, because the strategy was built for the trading style of the strategy developer. It was not built for you. So you're going to have a jacket that instead of doing this, it does that. In other words, it takes profit too quick. You are used to take profits you go for how many pips do you like to go? 50, 75, 25? All of us have a different measure. That's my main point. So you cannot just expect the system or the trading idea. You just read in some place, including my stuff, it's not going to fit you. I could ask someone to come here and try my jacket. It's not going to fit you. I'm not going to fit in your jacket too. So the first thing is make it very simple. Understand what you're reading about. If you want to build a trading system, think first about you. What type of trader are you? Do you like to trade range? Do you like to follow the trend? The euro-dollar has been in a downtrend, but now it's recovering. Do you like higher volatility, lower volatility? Do you trade when the system actually trades? One of the most profitable, not most profitable, one of the most popular systems was one that recently we found out that trading just during Asian hours. But Asian hours, the volume in terms of trading is really low. So people don't check it. They just switch it on. It traded so well until the day it blew up, like everything. And no one was watching it, so everyone lost lots of money. So if you trade during US hours, 8 a.m. until 12, you better find a system or a trading strategy or a trading idea from an article that trades well during the hours you trade. It's I came from New York. I'm still 3 hours ahead of you, right? My brain is 3 hours ahead of you. I woke up today, it was 5 a.m. and I did not know what to do. But I needed to fit here. And I feel uncomfortable today because of the time. So I went to Starbucks, had a coffee, but still feel uncomfortable. Because my trading strategy is 3 hours behind your trading strategy. And I'm sure people came here from different time zones. You must be messed up, right, too, a bit? Exactly. So the next time you think about buying a system or just following one of our trading ideas, just think twice. Does it really fit me? Do I really like it? The trading style and so on? No, just go ahead, choose a different one, because with the internet, there are plenty of trading ideas. The other thing is that traders like me, like you, like everyone else, we overestimate how good we are. So we look at the mirror, we see something different than the reality. I look at the mirror, I see a handsome guy. I'm not a handsome guy. You look at the mirror, you see something else. Like women look at the mirror, they see things that men don't see it. So the human brain is something so interesting but so powerful that we don't understand it. So when you buy a system, you should underestimate how good it is. Like instead of building a system, trying to make it perfect, and you optimize and all that stuff. But then by doing so, you're underestimating like how complex are the financial markets. Like they evolve, like we evolve, right? We evolve, kind of. Because one of the things we also notice, looking at all the stats among traders, is that very few people evolve. And the key to evolve is to look at the mirror and see, yes, I'm not that pretty. Yes, I'm a bit fat. So let me find some clothes or a trading system that actually fits me. We have one big bank trading one of my trading strategies. They have a few $1 million on it. But one of the conditions they negotiated with us was they could manipulate the money management. They can increase exposure and leverage. We give them the trading signals, but they have complete control how much they invest. So fortunately, they have been making lots of money, like lots of money, especially now. But there's no doubt in our mind that the day will come and they will lose everything. And there's nothing more ugly than a big bank having a margin call, because they do happen. And the worst thing can happen in that case when someone uses too much leverage, and that's what they did, is to make money. And we were like having these meetings, we were like, damn it, they actually made lots of money. And what they did next, the leverage was already too high, way beyond any standards for retail and so on. They increased leverage. So the P&L now is floating like a few, like thousands and thousands of dollars, not per day, but like per second and per minute. And you see how the stuff is going to end up, right? They're blaming us that our trading system is not good enough, so it's not fast to react. But what is in fact, is they're wearing our clothes and playing around with something that's not supposed to be played around. So I have no doubt in my mind, if I see you, all of you in 1 year, I'm going to tell, yeah, they blown up like around August. And it happens all the time. So one thing is just avoid it. Don't try to overestimate how good you are. How good is your strategy? Because the market changes, and change really quick. And worse than that, the market jumps. So the market is not smooth. The euro does not go from 138 to 130.001. Sometimes the market just jumps. So your stop losses, your everything is worthless. You're just going to get stopped out. Very often we get complaints from clients, maybe sometimes because of a fault, technical failure or something. The market is way too fast sometimes. But more than that is like the market is just like that. It jumps. Even the euro dollar, which is the most liquid market, only comparable to something here, the LIBOR market is also very liquid. Even the euro dollar jumps. So even if you use a stop loss, like, okay, I have a stop loss, I should be fine. No, you are not. You are not fine. And just like 15 months ago, other fund I work with, we're holding like a position in the Dow Jones Industrial. And we had a long exposure to stocks in that case. And the CME, once in a while, has problems, but never like that day. They were pretty much offline like 4 to 5 hours. And the stock market in that day fell like close to 200 points. So we could not get out. So I don't need to say that that was really bad day, like for us. Not because it was our fault, but because we don't even forecast. And then it becomes even worse. Like you come to the end of the day, we have a meeting, and we realize something. We could use other market to hedge our equity exposure. We could easily use the euro, which is highly correlated. So we did not anticipate that the CME could actually fail. Their system was like down. So you cannot like overestimate. If you underestimate, you're going to think about all these scenarios. Like New York City, unfortunately, and I had problems with my flight coming back because of that, is always like under a serious like terrorist threat, like all the time. And I remind me about that every day, because from my window I actually see the Freedom Tower going up, which is great. It's like it's going up. It's more than a building. You guys don't agree? So it has already a few floors. I don't know if you saw it. Anyone saw the new Freedom Tower going up? So they're just building it close to where World Trade Center was. They're really behind schedule. But it's going up. It has like 7, 8 floors. It's like every day it's a reminder that things can go really wrong. And the stock market closed, like during those days. It opened strong, but then kept falling. So you need to answer a few questions. Besides fitting the system or your strategy, you need to be able to fit it to your trading style and risk profile. Like, what returns you're trying to achieve? Don't tell me you're trying to achieve more than 30% a year. Like, don't. It's too much. Like, other conclusion of the studies we did, trading strategies and traders which try to achieve in the order of 100%. They may do so in the first year, but it's not sustainable. And currency volatility, which we measure by standard deviation of returns, going up and down, that's what is volatility, is in the order of 10 to 15%. So which means that with 95% certain, the market will move 20% a year. So 20% a year means that if you increase leverage like to 10%, leverage to 1 to 100, if the market moves 20%, you know how much you can move against your position, right? 2,000%. 2,000% if you use too much leverage. So you're going to get the margin call 20 times. So before you use a trading idea, just think about it. Like, we have these arguments all the time with Jamie, which sits close to me, and I keep telling him, yeah, he has really good trading ideas. He does. But you have to improve your discipline, because sometimes you overreact on the leverage. So here we have a really good trader that misses that simple point of discipline. Like, he has more trading ideas than I have. But I wish he could have more discipline. Then it could work together in our team. Like, we have also managed funds at FXCM. But does not help. Like, the main thing is discipline. So if you don't have discipline in terms of leverage, do not do it. I guess everyone in this room wants to achieve more than 30%, right? So if I tell you that 90% of you will lose all their money, it should not be a surprise. So just be careful. Think about trading like a business, right? Just wait a bit. First, learn with the market a little bit. If you push it too high, you're not going to survive for a long time. And I brought this stuff in the very beginning because I thought it was important. The trading strategy has to be very simple. Complex is usually not the best alternative. And one example of that is those traders that try to build a trading system that has everything there. Stop loss, limits, market conditions, prepare for X, Y, and Z. But sometimes your equity curve just starts going down. And what is the first thing? I blame, you blame the market. It's the market fault. Like, my trading strategy is perfect. It's the market fault. Like, it's going to change. It's going to turn. And then it gets way worse, and he's like, yeah, I'm an idiot. Right? Like, why didn't I think about it? So you need to look at it and say, yeah, it's pretty simple. The market is trending. The euro is trending. My strategy does very well on range-bound markets. So I'm losing money. Great. So you put that in a paper and you say, you know why you're losing money. But if you build it too complex, it may happen that you don't know why you make money, which is even worse because you're going to increase leverage, or why you lose money. Anyone saw Goldman Sachs giving a testimony last week? You notice, like, at certain point, one of the traders was asked so what the hell they were doing, shorting against the clients. And they said they were trying to take risk off the table, which is fine. All market makers do that. Like, if you think about Goldman is the perfect example of a dealing desk. Because they have to take the other side, offset the risk. Nothing is wrong with that until they step into a client and just prepare, like, I think they prepare like a portfolio chosen by the short side of the trade. But that's not the point I'm trying to make. One of the traders said something very important. He said, at a certain point, we're trying to sell and buy and offset the risk. But somehow, we're still losing money. So those credit derivatives were so complicated and so difficult to measure in terms of volatility that they could not figure out how to hedge. That's when you know you have a problem. And other example, probably that's the best one, Toyota, the Prius. Such a great car. If you go to New York City, it's packed with Prius. People love the Prius. Because, like, city is already expensive. And the car doesn't spend that much. So people buy it. But what happened recently? They had a problem, right? Two problems with the car. And one was the accelerator, I think. Do you know how much time it took them to figure out what was wrong with the car? A few weeks. Yes, I agree with that. They still did not figure it out. But what was the problem in that case? Too complex. They have been building these hybrid cars for such a long time. And they're doing like a good job with it. But they are so brand new that it creates problems that they don't understand. And the more complex it is, the worse it is. Third example, the space shuttle is made of millions of pieces. And on top of those pieces, you build software. Like, everyone in this room probably saw the blue screen in Windows or something crashing on your computer. So imagine that you are an astronaut and you go and suddenly you see a blue screen. And you're like, okay. And then you call, like, okay, Houston, I have a problem. It's a blue screen here. Like, it's too late. So in terms of trading systems, just keep it simple. Like, to the bone. Like, if he's there, it's because it's very important. And if you keep adding rules, like stuff you read, oh, this guy does that very well. No way. We developed a trading strategy like a month ago. Was one line of code. One line of code. It's like, we thought it was like a perfect system. Obviously it was not, but it's still doing very well. And it was one line of code. And it was pretty much looking at the market on every Monday. We were looking at the market every Monday. And under some seasonality. Seasonality is like a strong word to see that the market has some patterns during the month. Usually goes up in some time of the month. But we also figured out that if it goes up on Monday, there is a big chance it's going to go up on Friday. Why? We don't know. Long time ago, we already acknowledge that we don't know most of stuff. But it's okay. It works for some reason. So simple that we decided to test it, and has been doing like great. Maybe because the market, like on Monday, discounts lots of stuff that happens during the week. And then on the Friday, it's pretty much before the weekend. They remember themselves about the previous weekend, and they do it again. So I advise you, if you want to try something very simple, just put a trading strategy like that. Buy in a breakout of the Mondays, high and low. And you see how it goes on the euro. So you can send me an email then to DailyFX how the equity curve actually is. It's one line of code. If it doesn't do well, you know that it's because the market ranged, like it breaks, right? But then if it range, you're not going to make money. But the great thing is that you're not going to lose money too a lot. Because if it goes up and down, you just get stopped out, which is fine. Stopped out is part of the game. And you know what is the Lego system? Lego, that I think is Swedish, right? The thing that kids play and it put together, and they build bridges, they build dinosaurs. Like, it's really good to make the kids more creative. Like, they plug stuff together. This is a great approach for building or having a trading strategy. Like, how many of you already have one thing that you like to do on trading? Like, you know that stuff works. Like, very simple thing. Like, you know that when you do that, you're going to lose money. Or when you do that, you're going to make a little bit. Not so many. But those of you that already have it, you should keep it. It's a module. So you keep that module, which you know it already works, and then you build another module. Okay, I like this stuff. It's okay. It's like if you're trying to renew your house, you're not going to bring the house down, right? Because if you bring the house down, where are you going to live, right? So a modular approach is something used on software by big companies like Microsoft and Oracle and so on. And also called SOA. It's like software-oriented, like architecture, like service-oriented architecture. And it's very simple. Like, you build pieces of something, and then you put the bridge. So you know, like, you like to take profits after 25 pips. Let's make it an example. So you plug that module, and you say, okay, I'm going to take profits every 25 pips. Do not change that. Now, are you going to take stop loss, so protective stop losses? 50 pips. That's another module. The market conditions, if the market is nuts, like has been like in the euro dollar over the last 3 months, you have a module to identify the market condition, or you just look at the market. You know it. It's not very, volatility looks like he's about to break even higher, not lower, right? Like something is going on in the market, and the euro reacts really strongly to any news from Greece and so on. But that's another module. If you build a strategy, or if you use a systematic approach to trading that is like a building, a skyscraper, that's a very wrong approach. Because you build something here, then you pack it here, and you pack it here. It's very simple. If it shakes, everything goes down. So once the market does not go in your direction, that's fine. Just replace the module. Like Toyota does not need to replace the entire Prius. You replace the module, accelerator, and whatever they said it was. So you always have to keep in mind, no need to bring the entire thing down. Just look at it and make a module. From a coding perspective, for coding, instead of putting all the code in a single page, what we do, for instance, we put separate things. So we bring papers and you plug them together. So we have funds built of modules. So we have 10 modules, And you bring, for instance, one module is where is the majority of FXCM clients. Because we don't want to be, if the market already completely bought the euro, for instance, you want to apply this module and say, we don't want to also buy the euro because everyone already bought. And what's the big problem when everyone buys? Everyone has to sell, but more than that. What do you do after you buy? You just bought at the market, for instance. Like, what is your next step? Or the same step? Stop loss, right? So the market is 130. The euro has been like that. So everyone here is going to buy the euro. So we have half of the room bought the euro, right? The other half is going to buy the euro too, because it's much lower than it was and so on. Suddenly, only a few people here did not buy the euro. You want to be those few people, because you know everyone else not only bought the euro, but they also left their stop loss there. You know that FXCM or any broker hunts for stops. No, we are like FXCM is probably one of the largest brokerage firms for FX in the world, probably the largest. But compared with the trading volume overall, is like FXCM is this size. And the trading volume of the world is like the size of this entire room. So it's not that we're going to move the market against our clients. We can't, even if we wanted. Like, we can't. It's just way too big. And in these days, the market is so big, so large, that if you are a central bank, you better watch out. Because if a bunch of hedge funds get together on the other side, you better watch out. If you are the Swiss National Bank, because, for instance, they love to play with the market. But once in a while, they get a slap, because other banks get on the other side. And even the Swiss National Bank owns the currency. They do not own the market. So they know that the bank is actually buying it. So it skews on one side, so they get on the other side. So going back to this slide, one module will be, for instance, you could go to our site and check where is the majority of clients. We put that information all the time there. Just try to do that. Incorporate that in your trading style. What do you know about it? The majority of people lose money. Overall, taking the other side has been profitable over the last, and I backtest the results. I made the coding myself, and I can tell you that the strategy has been profitable in the last 10 years. The results are there. And you can even take a look and see that, yes, the majority of people are normally wrong. So the modular approach, you're already happy going back to your stop loss. You're happy with your limit order. So incorporate that module, or a module for some other broker. And you'll see that things start making sense and is easier. Because you use that modular approach, you don't like it, you remove it. You're not going to just completely shut down the system. And yes, the majority of people are on the wrong side of the trend. The majority of people buy the same books and all that stuff. And this is a big problem. And coming here, this presentation, I try to make it a big difference. But it's a big problem when everyone in the table is going to tell, yeah, you should always use a stop, you should always use a limit. Yes, you should. But you should always use the stop and make sure you are in the right side of the market. Because it's it's like putting a gun on this side, right? A majority of people has a gun on this side. You want to be on the other side. Because even if you are really certain about the market, I don't want to have a gun on that side. And what's happening all the time is that, our clients, the dollar CAD, for instance, has been falling a lot until it reached parity. The majority of people, our clients, losing money on dollar CAD because they're buying it and buying it and buying it. And if you like, for instance, a currency or a car when it's worth $100,000, You like the car even more when it's worth $50,000. So you like the dollar car even more. It's like so cheap now. Let's buy it and buy it and buy it. If you've not used leverage, going back to the Hong Kong example, that strategy is just great. Buying something that is cheaper works well, as long as you keep your leverage within comfortable level. So like having the stop there is not always the solution. Yes?
I was curious if you come up with a number of modules that seem to work together, but beyond that they become ineffective, too complicated, too many modules in the system.
Yes.
2 modules, 3 modules, I mean one for stock, one for market direction. How do you organize?
Very good question. There is one module we always use for money management. You never change that module. If we have $1 million account, we're not going to use more leverage. In our case, of 1 to 5, which sounds like really low for most of you. 1 to 5, 1 to 10, never more than that. So that module is always there. We just know it. We know that if we push too much, the returns will be great, but it's too much risk. So we don't change it. So what we do very often in changing the module, that actually looks at market conditions. We have one carry trade module, which is a fund, which we switched it off, luckily, just before the Lehman Brothers collapsed. Because one module it looks at overall risk market, the risk environment. And exchange rate volatility was way too high for carry trade to succeed. Other thing about the carry trade, it performs really well when the Federal Reserve has a positive interest rate expectations. It means they are expected to hike right now. Like now, the Fed is expected to hike. But we also look at the other thing, which you find like fascinating, like the options market. Lots of people, especially in Japan, these big companies, they hedge a lot the dollar yen. So when the dollar yen starts moving too much, like against all these exporters, Toyota, Sony, they start buying protection. And Japan is a big country, great country, but the system, the political system, the companies own shares of each other, everything is interconnected. So I have no doubt that they have more access to Japanese information than anyone here in the room. So you know more about the US, for instance, than other person in China. Because you watch the news, you see it, like the healthcare reform, like a bunch of different factors. And these people, these companies, on that very few months, they were hedging against a crash on the dollar yen like crazy. So their module was just printing red for us, so we switched off. And we have some big arguments. We also have some big arguments about what was about to happen. But like, not that we made money. It's like, was our best trade so far, I think. Like, we did not lose. So there, our equity curve went flat. And it was like, great. Flat, is that what we want? Especially when, like, Lehman Brothers went flat, equal to 0. And, yes? Yeah. Okay, fine. The last thing I want, everyone here can ask him questions after the session. But I'm not here selling any stuff. Okay? I'm not here selling any stuff. I don't open accounts for FXCM. Research is completely separate from our new accounts business. You can see it outside. I don't even know how to open an account in FXCM. We really separate things. And we also notice, it's like people that sell stuff, they only sell stuff if when it does not work for them. It's not personal, the majority of people. And it goes back to my slide in the very beginning. You should make your own homework. Like his approach, maybe is great, but just investigate his approach. Like many people have different approach. And no way, like at FXCM, I would like to sell any module that is doing really great. Because by itself, that will provide feedback against our own. Like you don't want to provide that type of information. What you want, and we do it that all the time, we provide free modules, like we tell you. Right now I'm just telling, the majority of people are often wrong. So just incorporate that information. And be very always suspicious when it's too easy. It looks too easy, because it's not. And going back to the optimization, curve fitting, people look at the past and they try to backtest their trading strategy. But going back to 2007, October, and 2008, if you backtest the strategy that trades stocks or trade the euro, the strategy would look great going back. It did extremely well. Stock market was doing great until the fall of 2007 and so on. The euro and so on. Over the last few years, who can imagine that euro would reach 160, right? 160. Like a few years ago, the euro was below parity against the dollar. It was at 160. So lots of people were curve fitting and optimizing their trading strategy to the past, exactly at the peak. So it's normally a good idea to have a strong feeling about what's going to happen next. So we call this a look forward approach. It's not a look forward type of backtesting. That's different. What I'm talking is about you look forward and you incorporate that look forward module in your trading strategy. Almost anyone that does that tends to perform better than the ones that curve fit. Just because the market itself, history repeats itself just in some type of scale. History does not repeat itself in the same shape. Like the Eurozone may break, yes, but that will be the first time it breaks. And you can say, yeah, I backtest this strategy like 20 years, has been working well. Well, there was no euro before 1999. So totally different market. There was a Deutsche Mark and there was a bunch of other currencies. There was like a Greek drachma, which may appear again. And market change and keeps evolving. It's like a living organism. So if you inject that module and you say, or your trading style, don't look just at the previous 2 years. Look forward. My advice, look forward. And I've been giving you the advice in the meeting of the funds we have. Look forward is what? 12 months time. Federal Reserve, increasing interest rates. Carry trade, probably performing well. Why? Banks will be increasing interest rate to fight inflation. Will it become 2011, 2012? Will it look like 2007? No way. Leverage is being removed from the system. Like politicians are just pushing for a new regulation, which is kind of going back and forth, but they will end up like deciding on something. A firm like Goldman Sachs is thinking twice before injecting more leverage into the system. So we know it, that 2007 no way will be like 2012 and 11. We also know something about China. they're having problems keeping the Chinese yuan like in SME peg to the dollar. Why? If you peg the currency, you have in domestic problems in terms of inflation, domestic problems in terms of managing interest rates and lending. And what happened? Your currency becomes too cheap, so your stock market goes out of control. Like it starts going up and up and up. So we'll probably have in 2 years, and this is a wild guess, or less than that, no more than 2 years, we'll have a floating Chinese yuan, which will change like everything. So instead of looking back, like be bold, like look forward. And if something really works well in the last 2 years, forget about it. Like it will not work like that. Unlike 2004 and 5 and 6, which you should look carefully at it, because that's when the Fed was increasing rates. And let's face it, like Fed is still primarily the central bank of the world. Like when they increase rates, the other ones follow through. And what we've seen is like the RBA, the central bank in Australia, increased rates a few times. But because the other banks didn't follow through, especially the Federal Reserve, they're now in deep problems. So everyone waits for the Fed. And once this starts happening, it's because the Fed only increases rates when the economy is doing well. So just be bold. Like in our case, we're going to probably favor carry trade. Like we were talking about the sterling earlier. Like who has memory of the pound yen trading at 250? It was 250. Now it's like 100 points below that level. We also like it a lot. Like we think that pair has kind of been like pretty much killed over the last like 2 years. But when things move away from their long-term average, they will keep up. They will go up. The dollar yen is the same thing. Dollar yen is pretty much, if you look at the last like 30 years, is in the bottom of that range. It may go lower, yes, but the potential to go to 120 and something like that is much higher. I'm not just recommending you to go and buy dollar yen. I'm just telling, make your bet, be bold, look forward. Do not buy a trading system or use a trading system that has a 45 degrees equity curve. Either that's fake or is curve fitting exactly to the past and will probably destroy itself. And we look a lot about this, especially our compliance department looks a lot about trading strategy sellers. And sometimes they get out of control because they all offer like really nice equity curves that only go up. It's incredible, but only go up. Like, if you buy something that only go up, your expectations are for what? To always go up. So it's not that the trading strategy they develop is really bad. Maybe it's good. But because your expectation is set, this stuff will only go up. Let me sell the house and put everything there. The moment you sell the house, boom, that's it. It starts falling. So just look forward. And instead of spending too much time looking at the past and back testing stuff, don't be afraid of live testing. Open a demo account, it's free. Not necessarily with FXCM, just open a demo account wherever you want. And trade. Try it. Spend like a few days back testing, looking back, but trade. Have a feeling how it behaves. It's like you go to the zoo, right? And some guy comes to me and says, you see that lion? He never killed anyone in the last 100 years. And he said, yeah, you're fine. You can go there and like pet the lion. It's like, you think, yes? You're not going to do that. So you have to test it. You have to be close to the lion for a while before you actually try to pet him. Would anyone here try to pet a lion? Maybe you would succeed. And what do? Probably you'd invite your friends to show them up. Yeah, you see, I can pet the lion. And then the lion will change his mind. So live testing is pretty much like the core of a successful trading system. Either that is MT4, either is TradeStation, either is Strategy Trader, something we're going to launch soon, or other system you just built. Either is your own trading style. Do not do live trading. Just like that. Demo, demo, demo. And then live, with a few, like, not a lot of money, really small leverage, live. But lots of time demo, lots of time live, and really little bit of time back testing. Look back. Have you ever heard about anyone that became wealthy because he demo tested well, or because his system worked really well in 2004? Like, no, he has to work well next year, and so on. And I put here this example because it's pretty much it. Like football players, like who saw the final of the World Cup like 4 years ago? It's like France was playing with Italy. And suddenly the best player of France, in the very few minutes of the game, just decided to punch the other guy with the head. Like, you cannot really backtest something that happens live. It's like very important, because while you live trade, you see that the trading platform has slippage. The price you execute is actually different than the price you see. Because the time your order goes, even if it's fast, you're going to have a small delay, which is enough for the market to move. Anyone here try to trade during non-farm payrolls? Yes, I thought it was much more people. Pretty much our trading volume goes like that, non-farm payrolls. Like it goes like this, and then clients start approaching. It's 8:29. They start putting their orders up and down, stacking them up here, and you see, oh my God. And they start keep buying and selling, buying. I did that myself a few years ago. It's pretty fun. It's pretty fun. Yeah, pretty fun. No, I did not trade non-farm payroll because I didn't even know about it. If I knew, I probably would lose it. But they stack the orders, and then it comes a big majority of people who trade after. So think about it. Everyone stacks the orders here. The payrolls comes. It's really strong payrolls, hopefully. That's what we need a job. It breaks to the upside. All these people making lots of money, right? Lucky. The other guys that shorted, the margin call like this. So they're making lots of money. And what they do, they take profits immediately. Immediately, they go for whatever it is there, they take profits like that. What happened? The market is still violent there, trading back and forth. And the spreads, unlike what many people do, the spreads is not like that. The spreads really, right? So you end up selling when the spread is like that. You want to sell it here, not want to make as much money as you could. So this was your lucky day. Next month will not be. And you're going to lose. I lose, everyone loses once in a while. And once you lose, people do not take the stops as quickly as they take profits. So that's a problem. You think it's going to reverse. So you start praying. It's going to reverse. And then it's 5 o'clock on Sunday, the market is about to close and you're still going to pray. And then you're oh, the platform is closed. You cannot close the position. So you go through the weekend, fully leveraged. So on Monday you open your trading platform, nothing is there. All the money is gone because you got the margin call. The moment the market opens way higher, you're just not there. So just try to live trade. It gives you a feeling. Once you're comfortable with your system or your trading style, just live trade a bit. You'll see that it's much harder to make money. But it's also the step you do, it's a step-by-step approach. One thing that never changed is like a simple rule. that the market can stay irrational more than you can stay solvent. And this goes with what I just said about the weekend. Like the market goes wherever it has to go. It's not that someone is telling, like, not a single person, not a single central bank has control over the market. It's about supply and demand. And we also know that the market, when there is panic, it becomes completely irrational. So people just try to cash in because they need the cash. Just for regular operations, like banks tried to cash in during 2007, 2008, because they needed to pay for salaries. So they were actually selling a bunch of like oil positions, dollar positions, just to pay for regular stuff. Obviously that doesn't work well, it just feeds into the panic. We're just like running a little bit out of time. We started a bit late. I'm going to ask my colleague to wait a little bit. And here is what I mentioned in the very beginning. Just to explain this, you have the euro dollar there. The histogram in the middle is the position of clients. When it's red, the majority of clients is short. So as the euro goes up, the majority of clients is short. As the euro goes down, the majority of clients is long, and then switch to long and short as the market moves. Do you see anything interesting there? Just in the middle, when the uptrend ends, the people start buying. Investors and retail traders, the FXCM, start buying the euro when it starts falling. So market psychology is the most important thing. It's not because people believe that the euro was strong. People believe that the euro was strong in the very beginning. But once the position goes against them, their belief becomes more, they are desperate to recover the money. So one module you always need to have is that module that takes you out. Like, I'm out. It's too much money. Like money management, I'm out. And you may tell, look, I need to evaluate, reevaluate, take a look again. What happened? And if your system is simple, you'll figure it out. And it's pretty much it. Like, you need to plan and design. You need to reassure like that the system is doing what it's supposed to do. You implement. Do not backtest. Do not demo test. Live trading, just for a bit. Like in these days, you can live trade with a micro account. It will cost you like $10. But in the long run, those $10 are like the best investment you can make. Like if you open a $25 account or $50 account, it's much better than demo trading $1 million. Because one of the things I always ask, do you live trade, demo trade? If you demo trade, then you tell me, yeah, I made like we hire lots of interns for DealFX and FXCM. And we make sure they start trading from the very beginning. Without any exception, most of them come to me and said, Antonio, I did so great. I'm up like $50,000. And they convince themselves, like, wow, so easy. And they do the worst thing. First, they have an intern salary, but they think they control the game, so they open a live account. So now you have an intern that does not want to work because he's sad, he lost money. He doesn't want to work for FXCM, for not a single company anymore. And they're like, okay, this happens to lots of people. So to make it a summary, you need to make a system that fits your trading style. Remember about the example I give about the jacket. Do not buy a jacket just because it's on sales, or a system that just because you feel it's great. Just see if it fits you. If you like how it takes stops and limits, if you feel comfortable with the style of the system, how often it trades, and so on. Make it simple and modular. Toyota Prius example we gave. Modular. Put the stop loss, the limit in one side, the market behavior on the other side, like where traders is the majority. Don't curve fit. always do more live trading, and keep improving the system. Like, that's what we do every day. We look at the market, and sometimes it can be incredibly frustrating because you don't understand it. And it happened to us like 2 years ago, 1 year ago. The market just not playing with us. Like, some systems that were supposed to be the best ones don't perform. And we cannot understand. And once you cannot understand something, and imagine you cannot understand like why your car is not working well, right? You go in the highway, just stop the car. And leverage is the equivalent of you don't understand what's wrong with the car, so you put the feet on accelerator. And it becomes even worse. We ran out of time. This has been a pleasure to be with you. I'll take questions after.